So you have to go back into like the taller section and go up the steps like back there. I never knew that place existed when I went here. There's like education offices in there, and the education, and then like social work. But yeah, I had no clue. Anything else before we get started? I feel like I'm forgetting something. That's why it's kind of messing with me. What's up?
Regression. So if I was going to run a regression on like the size of loans in comparison between banks and non-banks, and somehow that affected GDP, if I wanted to test for like introductions of new legislation that affects those, and causing a shift of loans in non-banks to the higher. Ideally, how would I test it?
So what are you trying to determine?
What should I test for new legislation in my?
Are you saying should you use that as control? Yeah. That's going to be tough. How many pieces of legislation do you think are going to affect that? Is it a lot, or is it just like Dodd-Frank?
Yeah, like 2 or 3. Maybe.
We'll have to talk about that later. My first thought is just do like a dummy variable, like 0 before Dodd-Frank, 1 after, but I'm not sure if that's appropriate. If you want to tease or at least see if there's an effect, you can do like an event study of just like the number of loans, and then just have a line where Dodd-Frank was, compare before and after, and see if there is an impact. If there's no impact, then you might not even need to include a dummy variable for that, or whatever like appropriate statistical technique.
I was just trying to think for it.
Yeah, because definitely if some legislation is going to have a big impact, you want to include that somewhere in the model. All right, let's get this show on the road. We're going to start with the lender of last resort. Does anyone have their notes? Was this the last place? Was this slide? Did we cover this or not?
Yes.
Okay, so Badge's dictum was where we want to start. Okay, so the basic idea of Badge's dictum, this was, to remind you, it's Walter Badgett. He was the second editor of The Economist magazine. He was pretty involved in banking. In the 1840s, sometime in the 1800s, he laid out his theory for how the Bank of England should act as a lender of last resort, because they had basically become the central bank of England at this time. Not officially, but kind of de facto. So first he said, lend freely to all banks that qualify. That the Bank of England was their job to lend to anyone that was worthy of getting a loan. So we're saving banks that are worth saving. We're not saving banks that are insolvent, that the assets they have are not enough to cover their liabilities. It's not rewarding banks. It's not creating moral hazard by saving banks, just bailing them out when they're unable to continue operating. The next is to announce in advance. So the Bank of England, in this case, he wanted the Bank of England to clearly state what they were going to do. So that way there wasn't so much panic in the financial market. Part of the reason is that you'll have to do less last resort lending if you announce to the market that you're willing to do it. It helps restore confidence, so there's fewer runs on banks, or banks are more willing to lend because they know if that one loan does go bad, they'll still have the Fed to backstop them, or in this case, the Bank of England to backstop them if they need it. So it helped prevent in the banking system back then drawing their reserves out of banks, and for depositors to not pull their cash out of regular commercial banks. But it's important, he said, to qualify that a bank must possess good collateral. So again, we're not supporting insolvent banks. These are banks that are in bad shape because of the economy, but not because of their own I don't know, mismanagement causing them to be insolvent. And he also said to lend at a penalty interest rate. This is, again, to prevent moral hazard. So you're not, a central bank or a lender of last resort can create moral hazard by being willing to lend to banks that suffer from their risky investments. Because there's less of a cost, there's less of a threat, they know that someone's there to bail them out at the end. Banks would be more likely to take on riskier and riskier investments. So part of the way to control for that, to prevent the moral hazard, is to not support insolvent banks. The other part is to lend at a penalty interest rate. So even the banks that do have to go and get these, last resort lending, to get these in the United States discount loans, they're still getting them at a penalty interest, so it's more costly than lending at typical market interest rates. And this was how Michigan in the textbook describes last resort lending. He says, when the Federal Reserve was created, its most important role was intended to be as lender of last resort. To prevent banking panics from spinning out of control, the Fed was to provide reserves to banks when no one else would, thereby preventing banks and financial panics. So do you guys think this statement, especially what's in bold, the Fed was to provide reserves to banks when no one else would, does this follow Bagehot's dictum?
No.
I think you answered that last time.
Yeah, I did.
So anyone else have an opinion?
Because like the way Bagehot's dictum talks about it, you're not supposed to lend money to like insolvent banks.
Right, and he doesn't mention that. He just says provide reserves to banks when no one else would.
No one else would, then there's something obviously wrong.
Yeah. Now, in some cases, no one else is providing reserves to banks because of just the general panic in the financial market. So they could be solvent and illiquid, so they can't sell their assets quickly enough to cover, or they could even be solvent and liquid, and maybe they would just prefer to get a loan for something. I don't know. In those cases, maybe no one else will loan to them. So in that case, the Fed would be appropriate for them to loan. But just the phrase "when no one else would" makes it sound like insolvent banks, and he's not distinguishing between healthy banks and unhealthy banks. So I don't think Michigan is trying to argue with Bagehot's dictum. I think it's just a little bit of lazy wording in there. But it's important to note the solvency requirements, and that's 2 of the bullet points there, supporting solvent banks.
Didn't Selgin comment on that? And I don't know if this is past chapter or the chapter before that, but like with the claim that the Federal Reserve's main purpose was to like be a lender of last resort, when really its main purpose of founding was to make it an elastic currency.
Yeah, that was the like if you read the Act, the Federal Reserve Act, that was like the first thing they mentioned. They say like to establish an elastic currency, because that was the main problem they were dealing with, like we talked about last chapter. So maybe even that sentence isn't. Yeah, when the Fed was created, its most important role. I don't know if that's 100% accurate. Throughout the history of the Federal Reserve, and you can argue lender of last resort has been its most important function. But at the onset of its creation, it was to prevent seasonal swings in currency demand. And not to prevent, I don't know, the seasonal swings in demand from creating banking panics. There definitely was some lender of last resort inspiration there as well. Like I mentioned before, J.P. Morgan served as lender of last resort personally in 1907, which is just nuts thinking someone could be like that rich to save the banking system. But again, if the Fed, creates an elastic currency, more like Canada, that can respond to seasonal fluctuations in demand, you don't really need to be a lender of last resort. And we'll talk a little bit more when we talk about forward guidance about the Fed clearly communicating what they're going to do. Now, the next policy tool we're talking about is reserve requirements. So obviously, a change in the reserve requirements is going to change the money multiplier, like we talked about before. So we're impacting the money supply through changing reserve requirements. So the reserve requirements are the portion of deposits that a bank has to hold, either they're holding cash, either in their own vault or in deposit at the Federal Reserve. This way they're not lending out that money, that they have a certain amount on hand that are safe with the Federal Reserve, that if there was a bunch of depositors that went to their bank, or if another bank called in a loan from them, they would be able to cover those loans or those deposits. It's not really a problem now because we have deposit insurance. Your bank account's insured up to like I think 175K. But in the past, when there was no FDIC, up until the Great Depression, people would literally run to their banks and try to withdraw all the money they could. And like if your grandparents lived through the Great Depression, they probably have a shoebox and cash somewhere in their house, or they did, because they didn't trust banks. They didn't trust that like the money would be there. So requiring reserves is a way that the Fed is able to force some measure of safety on the banks, force them to keep cash on hand so that they're able to cover these things. So a decrease in the reserve requirements is expansionary because it increases the funds available in the banking system to lend to consumers and businesses. So when you reduce the reserve requirements, so instead of keeping 10% on hand, banks only have to keep 5% on hand. That's 5% of their assets they're now able to lend out without having to keep in cash. Obviously, that's going to be expansionary. The Board of Governors of the Federal Reserve has the sole authority over changes to reserve requirements. So when they're meeting, they can decide to lower it or raise it as they see fit to try to influence the money supply. Just to give you the opposite, an increase in the reserve requirements, that's going to reduce the amount of reserves that can be supported by a given monetary base. So it's going to lead to a contraction in the money supply. So it's the opposite of an increase in the reserve requirements. There's fewer funds available to lend out because now they have to keep more cash on hand. So there was an act in 1980, the Depository Institutions Deregulation and Monetary Control Act, that set the reserve requirements the same for all depository institutions. Prior to that, different types of banks had different levels of reserve requirements. So it was different whether it was like a savings and loan or a thrift or a regular commercial bank. In the past, there were a lot more. This was resulting from the Great Depression. There were a lot more regulations separating the types of assets that banks could invest in. And they could keep on hand. So you had commercial banks like taking deposits and making loans. Then you had like your saving loans and thrifts, some of them based on like mortgages, based on other things. We see a lot less of that now. And after the removal of Glass-Steagall, they allowed different types of banks to combine. So you had, for the first time, I think this was in the 90s, you had investment banks and commercial banks being able to merge. And so they could offer a ton of different services to their clients. The only problem is it can also be riskier for the economy if you have a commercial bank that's also making like investments. When we talk about the financial crisis, some of the causes, that's going to come into play. So currently, the reserve requirements, your textbook is actually out of date on that, slightly. So the reserve requirements are 0% on the first $6.3 million of bank reserves, and then 3% from 16.3 million to 124.2 million on their checkable deposits, and then 10% on checkable deposits over $124.2 million. So yeah, the Fed can vary the 10% requirement from between 8 and 14%. I don't really know why. I don't remember why. I guess just based on what they believe like the safetyness or the soundness of the bank is. They haven't changed reserve requirements in years. That used to be like their main policy tool. They try to influence the money supply. So like leading up to the Great Depression, they didn't conduct open market operations. They just changed reserve requirements. It's a lot more of a, I'd say, a blunt instrument than trying to use open market operations. I mean, there's really no guarantee if you lower the reserve requirements from 10% to 8%, no guarantee that a bank's going to lend all those out. They're definitely they should lend more, that's for sure, because now they're able to, but perhaps the bank is concerned about the current economic conditions. They think there's too much risk to lend it out, so they may just keep that money on hand. And as we've seen with the growth in excess reserves since the financial crisis, sometimes banks are concerned they don't want to lend out. So it's something that could happen. So open market operations is better, a better policy tool. And this is taken straight from the Fed website, showing the reserve requirements.
Why is it 124? Is it just in general? Most banks are kind of in that window, or
What's that?
like why is it 124?
Oh, I'm not sure how they picked that number. I'm trying to think how much like liabilities banks typically have.
Yeah.
Like they normally have a lot. Hard to imagine many banks with less than $16 million worth of assets. Some of the reason that they go from 3% up to 10%, I guess from 0 to 3 to 10, is the idea I don't know, that we still have of protecting smaller banks and encouraging smaller banks. So a lot of financial regulations take it easier on small banks than they do on like the large, systemically important financial institutions. So there are certain provisions in Dodd-Frank that are dialed back or completely like just removed for the small banks. Some of it is that that meeting some of these regulations and these requirements are expensive. So large banks can handle the cost, but small banks can't. Jamie Dimon, in an interview in I think 2014 or 2015, he said that that Dodd-Frank was great for J.P. Morgan. It was great for the other big banks because they had enough cash. They were large enough that they could handle these extra costs. My aunt works for Bank of America, and in her like lending department, there used to be like 8 VPs, all dealing with lending. They cut like the other 7, and she's the only one left, and they've been hiring lawyers to do compliance because of having to meet all these disclosures and all these different components of Dodd-Frank. A small bank can't handle that, so they make it much less expensive. They try to dial back these regulations on smaller banks to try to encourage their creation. Although since Dodd-Frank was passed, we've seen very few small banks actually form. There's been a significant drop-off in the number that just entered the market. You can look at it as a good thing or a bad thing. Good thing because larger banks are more diversified than smaller banks with like 1 or 2 branches. So they're less sensitive to regional fluctuations and whatever the local like jobs are. So Hershey closes a plant and there's a small bank in Hershey that could easily fail because now everyone's defaulting on their loans because Hershey moved out and they're out of a job now. The Bank of America branch isn't going to close there because they have a large network. They're well diversified. So it could actually support financial stability having fewer small banks. It could be a bad thing because, like we talked about before, big banks don't have the sort of local knowledge that small banks have. So people who could, they miss a student loan payment when they're like 22, and that tanks their credit. Since then, they've been really good. They're really creditworthy, and they have a great idea for their business. They're trustworthy. They would definitely pay it back if they got the loan. Their credit score doesn't reflect that, though, so a big bank may not lend to them when a small bank would know that. Since then, they've been good and be willing to lend to them. So, pros and cons to that, but that's just kind of a tangent. Okay, so going back to the difference between reserve requirements and open market operations, like which is better and worse. Open market operations tends to work better. So this is done at the initiative of the Fed. So they've got direct control rather than trying to influence bank behavior. Like I said, banks may not, if they reduce reserve requirements, banks may not lend out all that money. They can try to influence the direction, but they can't reach like a target like they can with open market operations. And that the Fed sets the target on how many assets they're going to buy or sell, and they buy or sell all those assets. Again, open market operations is flexible, so it works for either large or small changes. If reserve requirements are 10%, in a crisis, they can't quickly dropping it won't have a big effect as engaging in like open market operations, especially large open market operations. It's easily reversible. So if they make a mistake, in open market operations, they can just buy some back if they sold too many, or vice versa. And also the fix is instantaneous. So the policy, like immediately, they decide to buy assets from banks. They get the assets and they give money to those banks, and it can immediately take effect. I think the whole process takes like 15 minutes from when they announce it to when they execute all the sales. So say they make a mistake, they can immediately reverse it, 15 minutes. Instead of with reserve requirements, it takes time for banks to make those loans. So it takes a while for the initial purchase or the initial policy to take place. And then if the Fed determines, oh no, they've done too much, they've gone too far, we need to reverse this a little bit. Again, that takes time. So open market operations are just much quicker. Also, LMO is flexible for like small targets. So if there's those little fluctuations during the day that the Fed wants to take care of, that's going to go a little bit above or below the target for the federal funds rate, they can engage in those defensive open market operations. So they can do the repo agreements, the reverse repo agreements, quickly reverse that. And then there's no administrative delay. Like the TRAPS process, like I said, is quick. It takes like 15 minutes, so it's totally done. Things like discount lending takes a lot more time. Just the banks showing that they have the collateral, it takes time. They're not physically going to the discount window anymore like they used to, but that process takes a while. And reserve requirements also also can take more time. Yeah. I feel like there's something else to say there. Well, if I think about it, I'll tell you later. So now the interest on reserves, this is a new policy. So the previous three, the discount lending, open market operations, and reserve requirements, those were the old Fed policy, the three main tools they used. Interest on reserves is new. They were given the power to pay interest on reserves by congressional act in 2006, I think. But they weren't going to phase it in until, I believe, 2010 was when they'd actually begin. But because of the financial crisis, they moved it up to 2008. So initially, interest on reserves the idea was it would be used as a floor. So it's set below the federal funds rate. Just to set the floor of that quarter like they did, like we talked through, I don't know, probably like 3 weeks ago now. Because the excess reserves grew so large during the financial crisis and since then, interest on reserves has been an effective tool for monetary policy. So instead of engaging in open market operations, they can just change the excess reserves and banks will lend out or lend less, keep more excess reserves. And that's like the policy tool the Fed can use. The federal funds market is used substantially less than it was pre-crisis because banks have so many excess reserves on hand. Instead of borrowing or loaning to other banks, they've got this money already. So they really don't need to. It wouldn't make sense to have all this cash on hand and then borrow from someone else. So because there's so much less borrowing, there's just fewer parties involved in open market operations. Yeah, and it would take extremely large purchases in open market operations to influence the federal funds rate with such large excess reserves being held by banks. So not only is it easier to use interest on excess reserves, it's much more expensive to use open market operations because banks just have so many assets being held in excess reserves. Okay, and here's the relative advantages. The open market operation has been the dominant policy tool since, I don't know, dating back like 70, 80 years now. That's been the standard operating procedure for a long time. It has more control over transactions, flexible and precise, easily reversed, quickly implemented. The discount rate is a lot less used. It's not binding for a lot of banks. It can cause liquidity problems. If a bank goes and gets a discount loan, they're seen as being less financially stable than other banks. Other banks look at that and say, oh, they must not be able to get a loan from someone else, so they must be in trouble. So banks are a lot less willing to do that since Continental Illinois failed in '87 after using the discount window. And discount rate also increases uncertainty for banks, and using that instead of getting loans in the federal funds market. The main value of the discount window is its ability to do last resort lending during financial panics. So it's not used very often, but it's used in key moments. And during those times, the Fed wants to act in lender of last resort or needs to act as lender of last resort, having a discount window is extremely valuable for them. So here we have interbank loans and deposits. So your deposits are in the black here, and your interbank loans here. This is showing what I just talked about a minute ago, why open market operations are used a lot less. Interbank loans used to be much higher, dropped since since the recession. So they're used a lot less in order to meet the reserve requirements that the Fed sets. Instead of that, they have they keep more deposits. So engaging in open market operations when there's so much less interbank lending is more difficult. Here we have the repos outstanding and the fraction of assets funded by repos. So yeah, we can see the number of repos that banks have used has also fallen substantially since the financial crisis. So this black line, banks' repos were around 400 billion. So 4 trillion to 3.5 trillion. Financial crisis hits, plummets. Again, banks aren't using, or the Fed doesn't need to make repo purchases or repo sales, or reverse repos, when there's much less open market operations being used. Remember, these are used defensively when random daily fluctuations are going on. They're moving the federal funds rate away from the Fed's target. They conduct these, move them back quickly and can quickly be reversed once whatever temporary pressure is gone. They can remove it. That's one of the main reasons why markets freaked out so much like a month ago when the Fed finally began really doing repurchases again. People didn't know what to expect. It had been a while, and there were some substantial problems, and interest rates spiked. I don't know. There was a big worry in the financial press about it. Okay, so from mid-2008, so we're talking about during the financial crisis, to 2017, the fraction of bank funding accounted for by interbank borrowing and repos has plunged from 10.5% to 1.4%. So interbank borrowing, the federal funds market, and repos, the Fed's daily fine-tuning of open market operations, has decreased substantially over that time. Since 2007, 2008, with the slew of bank failures, a lot of banks find it too risky to engage in these interbank lending to meet the reserve requirements. Especially with interest rate and excess reserves being paid, that's much safer. So that makes it relatively costlier to engage in federal funds lending. They don't need to when they can make a small profit with zero risk. Why make a slightly bigger profit with what they see as substantially more risk? There's also changes to capital charges in Basel III, which makes it, again, costlier to engage in the federal funds market. So these are all reasons why open market operations, the traditional policy tool, is much more difficult now, and why the Fed has been doing interest rate and excess reserves as their main policy tool. One potential solution that George Selgin has offered is what he calls flexible open market operations, and he's called for phasing out the interest rate and excess reserves, so kind of reversing the Fed's new policy. And by flexible open market operations, he means instead of lending to just primary dealers, there's a certain set of counterparties that the Fed has decided that they'll buy and sell in open market operations, expanding that to allow all banks to do it, and even some large, even like insurance companies or like investment banks. That idea, shockingly, hasn't gotten much traction. Remember in our Fed, my first Fed Challenge presentation, we suggested they get rid of interest on excess reserves because the crisis was over. They shockingly did not like that policy when we told them to change the way they've been operating. So what the Fed has done is just use the interest rate and excess reserves as their main policy tool to conduct monetary policy, which is the other rational solution when open market operations is more difficult. All right, you guys have any questions so far? Anyone mad that they're done with open market operations? Okay. In a financial panic, the conventional monetary policy tools aren't the most effective. They can't. So literally, Michigan says they cannot do the job. But there's two main reasons that these tools, we have problems using them and why they're ineffective. First is the financial system seizes up so bad that it's unable to allocate capital properly. They can't send it to the most productive uses, so investment spending in the economy collapses. They're seen as too much risk, as the value of banks' assets decrease because of the stock market going down. Banks are less and less solvent. They start to become illiquid, and other banks don't want to lend to them. And when banks get in trouble, when, say, people are defaulting on their loans or firms are defaulting on their loans and going bankrupt, again, banks are less likely to lend out to firms and lend out to consumers because they're afraid that they're going to be unable to pay back those loans. Very rational response by the banks, but their rational response combines to make the economy much, much worse. And second, the negative shock to an economy can lead to what's called the zero lower bound problem. This is what happened in the financial crisis. The Fed pushed down the federal funds rate to 0 to 25 basis points, and that's as low as they can go. If they push interest rates negative, you're just going to have people holding cash instead of keeping money with negative interest rates, basically paying to have a bank account. No one's going to loan or borrow in the federal funds market. I guess no one's going to give loans in the federal funds market if they're going to make a negative return on it. Banks will just stockpile cash instead. So the Federal Reserve has a problem. Any central bank in this situation has a problem. Physical cash does not have an interest rate, so that puts a pretty strong barrier at 0% for interest rates. In some places, if paper currency is less used and there is substantial, serious risk in the economy, it may be worth it to go maybe negative 25 basis points. A couple countries have been able to do that, but it's extremely, extremely rare. Also, inflation has to be super low for that. The idea of the liquidity trap, after the rate of interest has fallen to a certain level, the liquidity preference may become virtually absolute. What I mean by that is that everyone prefers holding cash rather than holding a debt that has a super low rate of interest. So while people may prefer to make some money on interest on, say, short-term bonds, they just find the value of liquidity, of having physical cash on hand to be able to spend, it becomes more valuable than the very small interest rate that they can earn from investing in assets and then needing time to be able to sell those in order to make purchases. Especially when you're in a financial panic, the liquidity becomes much more valuable. And because of the idea of segmented markets, some countries can go a little bit below the zero lower bound. Basic idea of segmented markets is that people have different preferences for the time length or the maturities of the bonds they buy. Um, so instead of, like in theory, your the interest rate on a 10-year bond should be like the interest rate on 10 one-year bonds, like each year combined. They should be equal to each other. The idea of segmented markets is some people want to hold short-term bonds because they're more liquid. Some people would prefer to hold longer-term bonds because they have a greater interest rate. So if segmented markets, if that theory is true, or if it holds for enough people will be willing to hold these short-term assets at slightly negative interest rates. I mean, like, you know, like negative 25 basis points, nothing, not like 5% or something. They'll be willing to hold them because they want that short-term liquidity. Okay, so, all right, I guess someone asked me a question about what we're talking about, and then we'll get out of here a little early. I'm not going to start and get halfway through something.